Another Wealth Coffee Chat. Welcome along. What is it? The 7th of July. 7th of July. Hopefully everyone is awesome and well, wherever you are in the world. While the old Facebook Live is warming up and things are getting going, I'll do the quick hellos and intros. Good morning, James. Morning, Alison. Good to see you guys. A few of the regulars are already jumping on. Welcome back to you guys. As always, awesome to have you here. For anyone who's new, give us a shout out in the chat. If you're wandering by, you're stumbling across it, or for the first time you've joined mentoring and you're getting on the Wealth Coffee Chats in the morning. Jason Winton's my name, one of the co-founders of Positive and property investor over 20 years. And coaching people over 18 years, and since 2003, so maybe 2002 actually. So yeah, along the way, learned a few things, done a few deals, helped a lot of people, made a lot of mistakes personally in investing, so I get to share them with you so you don't have to make them. There you go. But yeah, every morning, get together around about 8 o'clock with these crazy crew, a couple of Facebook peoples there. Craig, good morning. Some of you guys might be in behind the veil when it comes to the private Facebook groups. I think I've got a link actually I've got to send out to some of you guys, it was saying, so might track that down next time. Morning, Dane. Good to see you, mate, on the live this morning. That's awesome. There you go. Chris all the way in from Adelaide. Great to have you here, mate. Great to have you here. Alison. There you go. That is awesome, Alison. Diving right in. Fantastic to see. Getting right in there. Sustainability, I think it's a big industry for the future. Absolute gold mine when it comes to the world of real estate. Tanya's all the way in from Melbourne. Chilly Melbourne. Yeah, I can't complain. When I say it's cold here on the Gold Coast, I certainly can't. I probably should just keep it on the lowdown, shouldn't I, Tanya? I can't say. Happy 7th of the 7th. There you go. 7th of 7th. Well, hey, listen, today I wanted to have a quick Wealth Coffee Chat about some conversations in the last couple of days. Last couple of days, I've caught up with many people, prospective new clients, people who've been investing for quite a while. And it's an interesting chat, one that sort of popped up this morning. Morning, Ben. How are you, mate? All the way down from Melbourne as well. There you go, Nadine. Great to see you. Alison. Oh, that's great. Good to see a bunch of people on. Hey, listen. Over the last couple of weeks, it's been something that I've been seeing again and again about people having, JY, good to see, people having a lot of equity and they're thinking, oh, well, I'm rich. Right now, the marketplace, been going along, a little bit, and all of a sudden, we're all making dollars. We've all got some equity in our house. Our values have gone up. Now, some people have had some value increases in their properties in the last 12 months, 6 months, 10 months, 2 years. Some people have been getting value growth in their properties for years and years and years. And over the last couple of weeks, I've had a number of conversations with clients and prospective clients that have significant amount of equity, but their cash flow, their cash flow is extremely small. And what I see often in the world of investing and or not investing, this is an interesting one too, gang, that equity at some point starts to outstrip your ability to use it smartly, or the other one, which I see, is that we spend a long time paying off debts and giving the money, the bank back, creating equity that we can't get access to, or it's not doing us any favors. So let me show you what I mean when it comes to this concept I'm talking about. As always, like to draw a nice little graph here. And, you know, over time, when we have a look at our 3 phases, gang, you guys know the phases. This is something that I repeat again and again and again because it's good to burn it into our brain. The acquisition, the consolidation, the lifestyle phase. You know, we start out over here, you know, looking to get our real estate purchased, you know, and we might, you know, get going. We might have a principal place of residence, etc., etc. So, you know, our values, you know, might continue to rise like that, which is fantastic, okay? Now, our debt, which is something that we want to reduce over time, let's say the gap between here and here is sort of our loan-to-value ratio, and, you know, maybe we get a chance to debt reduce out here in, you know, 20 to 25 years as we go along. This is our debt. That's our debt. That's our value up the top there. That's our values. And at some point, we're going over here and we have quite a large gap here of value, but it's expressed in our world in equity, okay? Equity, massive amounts of equity. Now, this might include, gang, this could be you've just bought one property, one PPR, and this is an example of a number of people that are prospective clients that I had a chat with over the last couple of weeks, is they had a huge amount of equity in their home, in their PPR, okay, and I'm talking significance, millions and millions and millions of dollars in their principal place of residence value, but the cash flow they were creating from their wealth is zero. Zero, okay? So for you, for me, one of the biggest issues that we face when it comes to investing and creating cash flow from our world is the traditional or encouragement from well, no, it's not even advice, it's just bad ideas, is that you have to pay your home off as the number one priority, okay? Number one, okay? And this is where I see a lot of people get stuck, okay? Because when you give your, when you pay your home off and you make payments back to the bank gets to keep that money. You guys have heard me say this once or twice before. So what happens, if we go along here for a second, let's say you've got your property and your loan, you know, is about 80%, and, you know, you think, all right, over time, we're going to pay this down. We're going to make extra payments, make extra payments, make extra payments, make extra payments. And as you make those extra payments, you know, you were 30, now you're 40, now you're 50, and, yep, let's say, woohoo, you know, I'm 55, and my home loan, my property's worth 2 million, and my debt is 0, okay? Now, you're here, and this is a conversation I had the other day with one of these clients. I said, all right, where's your wealth? Okay, they had a small amount of money in their super, and all of their wealth was in here. 90% of their wealth was in their home, their PPR. They're now at this age here, and we're saying, all right, well, what are we going to do about that? I've had so many conversations in the last 2 weeks. It's not funny around this point. So now this is creating zero cash flow, zero. We're at an age where lending becomes an issue to be able to get access to your personal place of residence. So we've got all this money in here, but we might not be able to get access to it when it comes to lending. leverage and borrowing and going forward, okay? So for us as investors, for us as property owners planning our wealth into the future, you need to make sure you understand how and when it's appropriate to pay off your home. Because when we go back to our strategy or the big picture, if you put a lot of cash into your principal place of residence and pay your home off faster at the wrong time, if your plan is to, number one, I want 5 investment properties, number 2, I want $150,000 of passive income from my cash flow, okay, and number 3, I want to pay my home off, okay, then you can't get these mixed up. You can't mix them up, gang. Paying the home off can't be number 1 if you want to create a property portfolio. It has to be number 3 or number 4, okay? Because over here, this is often in this sort of section when it comes to the consolidation phase, this is the section where we go, right, principal place of residence, we've done our acquisition, we've got our, 1, 2, 3, 4, 5 properties, okay? At this section here, this is where we might target the principal place of residence to debt reduce, okay? Don't do it too early. Don't pay off your home too early if you want to build an investment property portfolio. Don't pay your home off too early in the wrong way, okay? And we've talked about this before as well. Offset accounts, redraw facilities, equity lock, loan splits, the whole kit and caboodle. Gang, if you go to the bank, you go to a financial planner and they say, oh, you've got a lot of debt on your home, let's pay that off quick, and you pour all of your resources into the loan in the wrong way, number 1, you're only making the bank richer and you become poorer, okay? Equity, not at work, or capital growth on your property is a vanity metric. It's a vain concept, right? It makes you feel good. It makes us feel nice. But gang, don't fall into the trap that, oh, look at all the equity that I've got. Look at all the value that I've got. I'm rich. No, you're not. You're the richest poor person you will know, okay? And for us in our social system, we're socialized to say, oh, debt is bad, pay your home off, pay your debt off, then you'll be safe and then you'll be happy. No, you bloody won't. You pay your house off and then you'll be old and you can't borrow any more money. Over here, you can't borrow to create that property portfolio that you want, okay? So hopefully that's making sense, gang. Along the way, I just wanted to sort of do a bit of a wealth coffee chat on that one about equity. Don't get caught up in, there you go, Christopher. Yeah, mate, I tell you, gang, listen, it is a weird thing that you look at your property portfolio and you've got, 1, 2, 3, 4, 5 properties. Certainly in this phase down here, gang, down in this phase, down the acquisition phase, all of your resources are going into purchasing the property, okay? And this is the gap. It's just a small gap between the cost, which is your debts, gang, and your value, and or call this little yellow line, the rents, okay? So we have to be patient with our portfolio and we have to give it some time for the cost to reduce, either because the values go up, the rents go up, the values go up, because that happens, right? Over time, this is a 20-year graph. Over time, 20 years, our rents and our values go up. Over time, at some point, your costs and your debts will go down. And then this is where we need to make sure the equity's actually producing cash flow. Imagine the only equity in this gap here was your principal place of residence. This is it, right? You've got a PPR worth $2 million, and here's your cash flow line. Actually, it's negative because the costs as we're going along. But you guys get the point as we're going along, gang. So hopefully that makes sense along the way. Sonia asked the question, what do you do if you find yourself in that position, Sonia? Well, certainly you need to, if you want to tap into the resources that you have. So, and this is a good one. This is a great question, Sonia. And thanks for shouting out, because I was putting out the problem without any suggestions. It is a problem if you want to build a property portfolio, or you want to create your own wealth, or you want to create your own cash flow in the future, because your resources are locked in places that you can't get access to, or right now you're not structured to get access to. Number one thing, Sonia, is you need to catch up with someone who can help you create a plan to unlock that stuff, okay? And that's what we do. If you want us to help you, give us a shout out, DM me, or find someone you trust, someone who knows what they're doing, okay? Someone who's an actual property investor, someone who actually created wealth, someone who actually, been here and done that. And if you find a good person, they'll help you create a plan to unlock it, because there is a few things to get done, Sonia. Number one, you've got to make sure your income looks good to be able to borrow. It's your equity is, if you've got equity there, if you don't have income, then you need to solve that challenge. And then also you need to make sure you have a look at how much you want to get access to and what you want to do with it. It's not, listen, it's not the end of the world. If you've already paid your home off, which is awesome, which is brilliant, you've kind of like done the end part first, then we have to just come back and create a plan where we are. Because listen, what I see, Sonia, in this, if you don't mind me using you as a quick example here, what happens is we've done paying our home off with so much effort, and we're so proud, and we've achieved it and all this sort of stuff. And in our heads, in our minds, in our hearts, like it absolutely either terrifies us or confuses us that we would now go and use our home to release equity, and now we've got debt on our home. And I'm like, weren't I meant to pay my home off, and aren't I meant to be rich now, and all that sort of stuff? It's a bit confusing. So get some support in that sort of space. If you've paid your home off, great. The only debt you will ever have going forward from here will be debt that is tax deductible, will be debt that creates a positive income, will be debt that owns an asset that goes up in value over the long term. You're in a great position. You've just done the sequence in a different way. It's not the end of the world, but you need to crack on if you want to with that sort of stuff. So great question. More than happy to do a little bit of an update on that one, gang. So thanks for joining me today. Hopefully a few of you guys got something out of it. Warren, 55. Now listen, it's not it's not the end of the world when you're 55, but it does make things more difficult. When you get to 60, 65 and your income is less reliable, that's when it becomes an issue. So I would say to Warren, and there's a couple of other people, Naomi, and a few, then Nadine. For some of you guys at this end here, at this equity end, this is where you can do some things a little bit different. If your borrowing is challenging, so let's say you can't borrow another $1 million, but you could borrow 300,000. Okay, I don't know what's going on with my pen here. All right, stand by, caller. We'll get another pen. 300. let's say you could release 200 or 300 of your equity out of your property portfolio at this end, then I've talked about this before. This is where you can do such things, and I've just called it a fancy name called equity arbitrage. I had a conversation with a client the other day. They can't borrow to buy a direct property now, okay? So they're a bit older. They can release $300,000. They've already got a facility against their home for 300 grand. That's it. That's all they can borrow. They've got a few properties already, so they've got a portfolio going, okay? So what happens is we now release this money, and it gets released at about 3% interest, which is brilliant, okay, which is tax deductible cost. And now we are getting 15 to 20% on that $300,000 for those clients, okay, in equity arbitrage investing, okay? And so that's what we can do. It's the kind of advanced section of accelerating our equity. In the 7 plans, we call it the acceleration plan for us as investors. So hopefully that makes sense, gang. It's a big question, isn't it? It's a big thing to make sure we understand where we're at with it all. But great questions there, gang, and thanks for dialing in today. And hopefully makes sense. Oh, hey, Brendan. Listen, mate. Track us down on our Facebook group, on our Facebook page at Positive Real Estate. We do some events. You can come along, and they're free events. You can come along and check one of those out. If you want to direct message me, find me, Jason J. Witten. Just send me a message, and we can have a chat about what those things look like. We've got coaches in many places around Australia. If you're a business owner, and you turn over more than $1 million a year, you might get to work with me. If you're in the PAYG space, you might get to work with some of our coaches. Yeah, mate, I'm happy to have a chat if you're interested to find out what we do, helping our clients. So there you go. All right, gang. I think it's been a bit of a longer one today, but it's a big question. Don't be the richest poor person you know, because at the end of the day, over here, when you've got your home paid off, you want to stay there. You've spent years fixing that home up, and it's great. And you want to live there for the next 10 or 15 years of your life. But you want income, you want cash flow, and that's important to understand how to make that happen, how to make that work. And right now, with the market around Australia, there's a lot of equity-rich people who don't have any cash flow. Let's not miss this opportunity to maybe unlock some of that equity and put it to work for you. All right, gang, that's it. Coffee and a chat done and dusted. Have an awesome rest of your day, and join me tomorrow. I do this every morning at around about 8 o'clock. If there's anything that you might think you might want me to chat about, chuck it in the chat, send me a message, put it on our posts, and I'll read them, and then I'll do a morning coffee chat on it, gang. All right, take care, guys. Have an awesome day, and chat soon. Bye-bye.